Hi, welcome back to my channel. Today we are talking about the agentic economy, and we did talk about the agentic economy in my last video, but today we are looking at specifically agent trading and how that compares to trading with a bot or human trading. So let's get into it. I'm just going to jump right in. We're going to do Honey, I Shrunk the Kids again. And there goes Mel down over here. In our last video, we talked about this quadrant here. We all grew up in a world where we have human-to-human transactions. And as of 2025, which is not that long ago, we were introduced to a new environment where agents are out in the interwebs transacting, and they're not just out there transacting by themselves. They're transacting with either humans or other agents, other AI agents. So we made this quadrant to illustrate that either we have human to human or human to agent to human, or agent to agent transactions. And I'm interested to see how this all shakes out. So I've been asking my Hermes to keep me updated, and he made a new presentation, a couple of them that we're going to briefly go over this one. In this particular framing, we're looking at a couple of different factors. We've got human to bot, bot to agent to agent, and agent to human. Bots versus agents. I've noticed that as I talk about trading, I automatically say bot, or when I'm talking about agents, sometimes I say bot when I mean agent, or agent when I mean bot. And I wanted to clarify that everyone uses bot and agent interchangeably. They are not the same thing. Bots follow rules and agents follow or pursue goals. This distinction determines everything about how the financial markets are changing. Trading bot follows a fixed rule or fixed rules. They execute predefined logic. They are single task focused. They're pure code. No understanding of context, cannot learn or improve. It's simply a program. And then we have agents that can pursue goals, not rules, and rules are supposed to pursue rules as well. Reasons and plans, multi-tool and multi-chain, understands context and learns from outcomes, or is self-improving, has these self-improving loops. I wouldn't say it learns, but it has self-improving loops. And bots follow rules. Agents pursue goals. So we're going to look at these different properties. We've got decision-making, adaptability, inputs, learning, scope, and example. So in this first column, you'll see it says trading bot. And trading bots, like we just went through, have predefined rules. Adaptability, they have zero adaptability because the same logic is always constant. And the inputs are price feeds and indicators. Those are the only inputs you can give it. Learning is static unless it's reprogrammed. So in order for it to change, it has to be reprogrammed by a human. And the scope is a single task, usually in a grid trade. An example instruction for a grid trade would be buy at 90 and sell at 100. Okay, staying in a range. So if you have a range from $90 to $100 and you notice that the stock or the crypto is just kind of pinging around in there, then you can set a trading bot up to buy down here and sell up here. And it'll just keep staying in that range as long as that range holds. But as eventually that range will change either up or down. And if you don't reprogram your bot will just stay in that range. Nothing's happening. So you're not making or churning any money. And now the range is down over here or up over here. And you have to change all that. Okay, but with an AI agent, it's LLM-based reasoning, for better or for worse, and adapts to market conditions, price news. So inputs can be price, news, social, or on-chain metrics. Then learning, yes, it can self-improve from outcomes. Scope is multi-tool and multi-chain, and you could give it an instruction like keep my portfolio market neutral, and it should be able to follow that. I would imagine it needs more instructions than that. It obviously depends on the model. So RPC Fast on-chain AI agents has 3 properties a traditional bot does not. Goals, not rules. You tell the agent what you want. Keep this portfolio market neutral. Trade narratives surfaced by these accounts, and so on. Can Hyperliquid tell who's trading? So so for those of you that don't follow crypto, I cannot assume that everybody here understands what's going on in the cryptocurrency space. So what I want to do with you just quickly is go to, pull up the chart really quickly. And so here we have the chart. So I'm going to put full chart. And I just end up in the way no matter where I go, huh? All right, down here, I wanted to get you the year-over-year numbers. So down here at the end of December of 2025 and the beginning of January 2026, Hyperliquid was trading around between $28 was the high and the low was 21. And since then, it has gone up. And it's now trading between 52 and $60. Okay. So that's the new range, but you'll see that there's a trend line here. Okay. There's a trend line. It's following this trend line and it is up year over year, which if you're unaware is strange in crypto right now. Crypto is big old poopy doopy. Okay. Poopy doopy. Poopy doopy chart here for Bitcoin. And if you didn't know, and then everybody's like, well, there's more cryptos than Bitcoin. Yes, there are more cryptos than Bitcoin. I just showed you Hyperliquid, but the majority of the market, 99% of the market's chart will look like this because 99% of the market will follow, or every coin, every cryptocurrency is pegged to BTC. Okay. BTC is the market leader. It's the largest crypto. And you'll see in the same range. So from January, the end of December to the beginning of January, Bitcoin is over here in the 80s. So it's like going from 80 up to $97,000 at the end of 2025 and the beginning of 2026. And you'll see it's in a downtrend. Totally different chart. Okay, different chart. And in crypto, and just like the S&P 500, where if you have a stock on the stock market and it's a $10 small cap stock and you're really excited about it because you know that it's got a new patent that's going to be approved or something, and you go in there and you start buying, but then the S&P gives a poopy doopy. It just starts selling off, some market event, Trump tweets, everybody threats nuclear war, some god awful thing like they've been doing to us for the last, couple of years. And the market takes a sudden turn. Well, your little stock is also going to take a turn, even though there's nothing quote unquote wrong with your stock and you've got good news going on with your little $10 stock. The larger market will determine that everybody's selling off and they'll start selling off your stock too. Okay. And your stock's going down. A lot of new investors will be like, well, why is my stock down when it's all this great news is coming out? I don't understand. It's because the market conditions are not good that day for the trend going up, right? Yeah, so one kind of little tip in trading, I'm not a trader, I don't trade, but kind of the basics are if the S&P is going down, anything else you're trading that day is more likely to go down. If the S&P is on an uptrend, then anything you're trading that day is more likely to go up. So it's always good to keep track of these market leading stocks, right? Same thing with crypto. You have BTC really pegging the entire market. And not to say that Hyperliquid isn't influenced at all by the BTC price. That would not be true either. But it is certainly going against the grain here. And the question is why? So the why is that Hyperliquid is a cryptocurrency that focuses on commodities and based out of Switzerland. And when gold prices went crazy, everybody got in there and wanted to trade it. The traders want to trade what's volatile and what's hot, because they know that they're going to be able to make more money that way. So everybody piled in over on Hyperliquid, and also again with oil. Oil was crazy. So commodities trading with cryptocurrency was a new way of trading, and now agents are able to trade over there on Hyperliquid, and all of this the market conditions and the platform that Hyperliquid is on, allowing for agents to trade, has completely catapulted their business, and they are doing very well over there at Hyperliquid. And anytime I see an outlier like this, it piques my interest. I find it to be interesting. Okay. And then I look into it. So that's what I'm doing. I'm looking into this, and yes, I do own Hyperliquid. I've owned it since 2025, and not a lot. I don't own a lot of crypto, but I do follow it. And here we'll go back to my question about this to Hermes, which was, can Hyperliquid tell who's trading? So I was interested to know, how do we know how much of this are bots? How do we know how much of this are agents? How do we know what's human? And Hyperliquid is the leading decentralized perpetuals exchange with over $5 billion daily volume. It has a public API with an approved agent system, but can it actually distinguish a human from a bot, or a bot from an agent? And the answer is more nuanced than you would think. So we're going to look into that. So you've got, within Hyperliquid, you get a master wallet, and this is the human's main wallet. And then you go through approve agent process, record on chain, and you can get a bot wallet, an AI agent wallet, and a human browser wallet. And so what's visible on chain are the agent wallet addresses, which are different from the master, agent name, if the owner decides to name it differently, all trades signed by the agent key, not the master, and trade timing, size, frequency patterns. But what we don't know is whether it's a bot or an AI agent. And what we don't know is we don't know the logic that drives the decision and the trading. So what Hyperliquid can see, which is your wallet address placing a trade, and when a user calls approve agent, a separate agent wallet address is created and recorded on chain. Every trade signed by that agent wallet is visible. Hyperliquid cannot see whether the agent wallet is running a simple grid bot or a sophisticated LLM. Agent names help partially, because when approving an agent, users can give it a name like Hyper Agent. Tracking these names can identify which bot platform is being used. Behavioral analysis is the only real signal we have. Trade frequency, size patterns, response time to market. Of course, we know that agents are faster, so that would be an indicator. And multi-venue coordination can hint at automation level trading. Second finality favors agents. So Hyperliquid architecture gives sub-second block finality. AI agents can react to market conditions before human traders even acknowledge the price. This structural advantage means that agents will naturally dominate on speed in this environment. So the 4 quadrants of trading, so apply to the financial markets, which we looked at before yesterday. The 4 transaction types become human to bot, bot to agent, agent driven market moves, agent to agent, or agent to human, like we talked about before. And here, considering trading, so this is the financial trading map, we have agent to human, human to bot, human to agent, and agent to agent. 4 ways to trade in this financial quadrant. So human to bot, a person sets up a trading bot with fixed parameters. Then you have human to agent, a person gives an AI agent a goal. And agent to agent focus, which is AI agents trade against other AI agents. On Polymarket, 30% of wallet activity is AI agents. The Polystrat agent completed 4,200 trades in its first month, with peak returns at 376% on individual positions. AI to human, where an AI alerts humans to opportunities, red flags, or hands off for a final decision. 91% of financial services are using this in this capacity. Measuring success, human versus AI. And then my question was, well, how successful are AI agents compared to human traders? So how do we know if an AI agent actually trades better than a human? The data from prediction markets give us the clearest picture. So we're just looking at the prediction markets, which is basically Polymarket. And you have profitable traders, AI agents versus humans. So 37% achieved positive returns, which is actually very, very high. When you compare that to human traders, so human traders, which is very generous, is 7 to 13% are achieving positive returns. And of course, it depends on if you're looking at just each individual trade by themselves, or if you're looking at the entire day for that person, or for the entire year. What time period are you looking at? How many trades? But this report is saying 37% of the time agents experience positive returns. And Polymarket data, 37% of AI agents achieve positive returns compared to only 7 to 13% of human traders on the same platform. But the deeper story is more nuanced. Bloomberg analysis in April of 2026, humans actually chose the right side more frequently. They just entered later at worse positions because they executed more slowly, size positions incorrectly or inconsistently, and enter and exit too early based off of emotion or at the wrong times. AI agents now represent over 30% of all wallet activity on Polymarket. Then we have OpenClaw cautionary tale, a $441,000 error and a 62% loss by GPT-5 revealed brutality. So they found an example of an AI agent losing quite a bit of money. So obviously not financial advice. I'm not a financial advisor. I am a woman on the internet, on YouTube, in fact, talking to herself in her office, and you should not be taking financial advice from anyone on YouTube, especially me. And CFTC warnings. The CFTC has issued warnings about AI trading bot scams, and these scams promise like 90 or 100% win rates, and don't trust anybody, okay, because they're not verified returns. Trading strategies and real world examples. So let's see what the people are doing out there and what's happening. So we have narrative surfing. We have agent monitors X or Twitter for emerging crypto news, or identifies trends, win topics, and trades before the crowd. And this is AIXBT on Base. So Coinbase is doing this strategy. Some people were following Trump tweets and trading based off of that, and it was very successful. Prediction market arbitrage. Agent identifies mispriced prediction market contracts and executes arbitrage. So it finds an inconsistency or inefficiency in the market and may look across multiple platforms and see, hey, this asset is 10% lower over here. Let me go buy that and then wait for the exchange to catch up and then sell it when it does catch up. Market neutral hedging agent maintains delta neutral positions across venues, rebalancing automatically. You also have whale tracking, which is available on Hyperliquid. Agent tracks large wallet movements on chain and executes trades before the market reacts. And then you have a strategy marketplace. Top traders package strategies as AI agents and sell them to others. Buyers get the agent, seller monetizes the expertise without trading personally. And then you have DeFi yield optimization. And this is actually the one that I'm most interested in because staking and pools and all this stuff is a pain in the ass. And part of my thesis is that this crypto thing will not take off until the average person is able to stake on their own and move crypto around comfortably. And I believe one of the paths to doing that is with AI agents. And the idea here is that the agent moves capital across lending protocols, LPs, and staking to maximize yield. Multi-chain, multi-protocol, 1inch, and DF AI agents or DeFi agents, and this is multi-chain. Okay, so then we have the growth data. So we definitely see that this is growing over time. We have a comparison to how much is AI trading growing year over year and how much is algorithmic trading growing year over year. And the algorithmic market is still very large. It's $20 billion in the US and projected to reach 30 billion by 2031, which is a 7.8% annual growth rate. And crypto AI trading is approximately 5 billion in the US in 2025, expected to grow over here. So this purple line is the AI agent line, and it's expected to be at about 8 billion this year. And in 2027, it's expected to be somewhere around 15 billion. So in 2029, it's expected to be around 27 billion, and then in 2030 or 2031, $55 billion market. What does this mean? Okay, so I asked Hermes to explain to me the difference between the speed of trading and the velocity of money, and let's look at the history of the velocity of money and the speed of trading, because to me it seemed like the market changed as soon as OpenClaw was released to the public. It was like the market went wild, and also the market crashed. Some stocks crashed, and that's when we had a lot of the fears over software and the like. But I also suspect that the velocity of trading increased at this moment because I know obviously this made it where agents were available to retail traders. So retail traders were able to get up in there and start trading. But I also know that Wall Street and the institutions have been focused on how to use these technologies to make more money. They were all over the algorithmic trading, and I guarantee you they are all over this AI agent bot trading. Okay. And when I say AI agent and bot trading, doesn't mean that you can only use AI agents or only use bots. Many people are using both. So they're using the AI agents to manage their bots or manage their scripts. Okay, so they're actually using both hard-coded software and bots along with the AI agents managing that and making adjustments on the fly, because they can do it 24/7. They can do it faster than any human. And there's a huge advantage there. You saw that humans are successful 7 to about 10% of the time, and AI agents are like 400 times more profitable and more successful than humans in this environment. How fast money changes hands, how fast trades happen, and what happened after COVID is my question. After the dot-com bubble, I want to know what happened after the dot-com bubble and after trading agents arrived. Okay, so we go down here and we talk about what is the definition of the velocity of money. The velocity of money is how often money changes hands over a given time period. So for example, let's say I go outside and I hop in a cab and I give that person $1, and that person on their lunch break spends that $1 on coffee, and then that barista goes and spends that $1 on some candy at her lunch break at a grocery store, and then that grocery store spends that money on restocking the candy. That is the money changing hands 4 times, and if it happens in a day or if it happens in a month, that is what we are looking at with the velocity of money. The velocity of money measures how often one unit of currency is used to purchase domestically produced goods and services within a given time period, okay? And it's also expressed as the quantity theory of money. So you've got money supply times velocity equals price level times real output. All right. And we talked about the velocity of money. So you have $20, you give it to a store, that's the same $20. So it's how often that same $20 goes through the system is the velocity of money. All right. And with this chart, we're looking at the velocity of money between 1959 to 2006. So in 1960, the velocity of money was about 1.5. And then the peak of the velocity of money was in the dot-com bubble. Okay, so it went way up here to 2.19, which is the highest it's been in history, and it's been declining ever since. Okay, it declined all the way down to 2020. It's never gone back to the peak of the dot-com bubble, surprisingly enough. Okay, we'll talk about some of that here in a minute, but we've got this 2.19 peak velocity in the dot-com boom, the highest ever recorded according to Fred. And Fred is the Federal Reserve Bank of Illinois. Okay, and that's where this information is coming from, also represented here. Okay. Then in a low in 2020, and then it bounced up, and now it's at about 1.4, okay, in 2026. So the all-time low was 1.13 in Q2 of 2020, the COVID lockdowns, okay, 19% single quarter drop. So it was already on this decline, and then it just came down and bounced up, okay, and then 1.412 is the current amount, which is still 36% below the peak in 1997. The COVID shock, this was the plunge, the 21% plunge during COVID and the gradual recovery here. And we are 25% from the low, all-time lows of the velocity of money. So we haven't even really fully recovered from the dot-com bubble. Okay, the people haven't recovered, because the velocity of money is basically looking at the domestic health of our economy and the people's economy, how fast the average person is moving money around. Economic lockdowns, restaurants, travel, entertainment shut down overnight. Don't remind me, I'm heavily traumatized still. Then we have second, the massive financial stimulus or fiscal stimulus, where $3 trillion in stimulus checks and PPP loans flooded into the money supply, which is the only reason why we had any kind of recovery out of that bottom. Uncertainty drove savings. People were scared and uncertain of their income and their paychecks, understandably so. So they increased their savings to 33% in April of 2020. And the service sector collapsed. We had huge damage to the hotel industry and restaurant and tourism industry. The dot-com boom, 1997 to 2000, velocity peaked at 2.192 in the third quarter of 1997. Then the bubble burst and velocity, the QE era velocity is falling here. The dot-com boom, 1995 to 2000, coincided with the highest money velocity ever recorded. Internet companies, day trading, online commerce, rapid economic activity pushed money to circulate faster than it ever had before. Then the bubble burst in March of 2000. The velocity began a 23-year decline that never fully reversed. Okay. Never reversed. Velocity of trading. So now we're moving on to kind of a different type of velocity. This is more the velocity of money for Wall Street, not for Main Street. So velocity of money is for more for Main Street. The velocity of trading is more indicating of what Wall Street is making and how profitable they're, or how much money they're making and how fast they're making it. So money velocity, how fast dollars circulate through the economy. And trading velocity is how fast assets are bought and sold, measured as turnover ratio, daily trading volume divided by total market value. So we have U.S. equity market turnover between 1990 and 2026. Okay, and they're back up to where they were in the dot-com bubble. Okay, even though Main Street is not, we're still never recovered. Wall Street has recovered. Okay, they're back up here at all-time highs at 250%. Velocity, money velocity has been declining over 25 years, but trading velocity has been rising for 25 years. They moved in opposite directions. Why? Because money circulates slowly through the real economy, GDP, but circulates rapidly through financial markets and trading. More of the economy's money is flowing through markets, not Main Street. Well, that's not good. The rise of algorithmic trading. So let's look at the history of this stuff, from punch cards to AI agents, the timeline of how machines took over the markets. The first programmed trading was in 1997. NYSE introduces DOT, which stands for Designated Order Turnaround System, in 1976. Then in the 1980s, we have institutional algorithmic trading. Then in 1998, you have SEC approves electronic exchanges to compete with the traditional exchanges. And then high frequency trading emerges. I remember this because then we started being able to trade through E-Trade was one of the first ones. And I started seeing E-Trade commercials on CNBC, and I actually started trading on E-Trade right when it came out. 2000 to 2005, high frequency trading emerges. HFT firms like Getco, TradeBot, and Tower Research capitalize on decimalization and sub-penny trading. So scalpers. Okay. Then high velocity trading hit 60% of equity volume in 2008, and then flash crash. So I remember this when the Dow dropped 1,000 points in minutes because of a flash crash, which was caused by algorithmic oopsie doopsies. Then in 2015, AI, ML, or machine learning trades go mainstream. Machine learning models are trading and move from quant shops to mainstream hedge funds. Firms like 2 Sigma, Citadel, and Point72 deploy machine learning at scale. And then 2020 COVID retail surge in bot trading. And this is really more when it becomes available to the average person, really understands that we have the option on some of these platforms to do bot trading in retail. So the plebes, Wall Street had a lot of this stuff back in 2010 and certainly by 2015. And then in 2020, it got trickled down to mainstream. Robinhood apps explode, retail trading surges, but beneath the surface, retail order flow is routed through algorithmic market makers. GameStop short squeeze reveals tension between retail and algo market makers. AI trading bot or AI trading era begins in 2024 to 2026. LLM powered trading agents emerge. OpenClaw basically unleashes this all to retail as well. Hyper Agent provides AI agent trading on Hyperliquid. Key distinction: bots flow with rules, agents pursue goals, agents can reason, adapt, and execute multi-step strategies. Bot trading versus agent trading. So we have the dimension, how it decides, adaptability, scope, when it starts, current volume, crypto adoption, can Hyperliquid tell, is the trading, and then we have a trading bot column, and then we have a trading agent column. So the trading bot follows pre-programmed rules. The adaptability, it cannot adapt. The scope is a single task. And when it started in the 1970s to 2000, and current volume is around 60 to 75% of the US equity market is on algorithmic trading, and crypto adoption, about 70% of stablecoin transactions are algorithmic. Can Hyperliquid tell? Partially, we talked about that already. And then the trading agent with LLM and AI, it decides, it reasons about goals, manages portfolio. Then adaptability, it can adapt to new market conditions and can learn from outcomes and adjust the strategy. The scope is multi-step. It can do more than one step. It can analyze, assess risk, execute across chains, and adjust positions. When did it start? In 2024, 2026. LLM agents like OpenClaw and Hyper Agent made it practical. Current volume, it's growing very fast, but a small base. So 30% of polymarket activity are AI agents, and AI agents in the crypto market about 15 billion as of the first quarter of 2026. Okay, so bots have dominated the market for 15 years, but bots are predictable. They follow rules. They can be gamed. Agents are unpredictable. They reason, they adapt, they pursue goals. The transition from bots to agents is the next inflection point in trading velocity. When agents can react to market events in seconds, in milliseconds, and can reason about what those events mean, the speed of trading accelerates again. Retail versus institutional. So in the era of the 1970s, programmable trades were happening, and the adoption was large sell side firms only. So that was only available to institutions. In the 1980s, quant models were available, and this was available only to specialized firms. And in the 2000s, high frequency trading, 60 to 70% of equity volume, which was mostly done by, again, large firms and institutional firms. 2015, machine learning trading, major hedge funds were the only ones in this market. And now with this AI trading, we've got retail and the institutions. The time compression between the moment that the institutions got the technology and the moment that the retailers got the technology has been compressed. They've been able to keep this stuff away from retail for quite a long time and only release it when they're ready for retail to have access to it, which were decades later. And now we're probably about 2 years behind. Instead of being decades behind, we're only a couple of years behind the institutions. But again, they still have more money than you and have faster machines and have teams of people managing these things. Okay, so there's still a disadvantage there. What we learned, the complete picture, velocity of money, velocity of trading, the agent inflection point. So money moves slower through the real economy than it did 25 years ago, but money moves faster through the financial markets than ever before. The gap between Main Street and Wall Street's velocity is widening. AI agents will widen it even further. Agents can trade in milliseconds and reason about what they're trading. The speed advantage of machines over humans is about to get another inflection point. One thing is for certain. Okay, one thing. So we have the DTCC tokenizing the stock exchange. Okay, the fact that they can't be over there on Hyperliquid like all the retailers and over there on Polymarket, I'm sure they are, but they want to be able to trade their stock market with all this shit.
They want to increase the velocity of money. The faster money moves, the more the banks are going to make, the more the people, the exchanges are going to make more money. If you can trade 24/7, if you can offer the casino 24/7, the casino holder is going to make more money. So on Wednesday, July 15th, the Depository Trust and Clearing Corporation, the DTCC, partnered with the NASDAQ and a host of other industry leaders for a landmark industry event that saw U.S. trades processed using tokenized assets in live production environment. They've been testing this out for a while. Okay, this effort aimed to help monetize the infrastructure beneath today's market by unlocking greater efficiency, enhancing liquidity, and enabling a global, always on financial system. It's all about you guys. But they tell you, right, it's about the infrastructure beneath the market. Who owns the infrastructure beneath the market? Okay. And these are the same people complaining about the Clarity Act and also complaining about the retail traders, the retail people getting stablecoin rewards or yield or being able to stake. They want to be able to rebuild the infrastructure of the entire stock market and make more money, increase the velocity of money, increase the number of transactions. The more transactions there are, the more money they make. But they also don't want you being able to stake your money and just, they don't want it sitting there. Like, why would they want you to get paid for your money to just sit there? They don't want that. They want you over here in their casino trading 24/7. Okay. This event demonstrated that the DTCC tokenization service can serve as a bridge between mainstream markets and the digital market infrastructure. Throughout the day, DTC successfully converted DTC held assets into tokens used in production trades on the NASDAQ stock market. The milestone demonstrated how tokenized assets can be used across a range of use cases, asset classes, and number of participants, paving the way for the launch of the DTCC tokenization service later this year. NASDAQ's role. Okay, so these people are talking about tokenizing the stock markets. There's other ones. You can look it up yourself. I'm not going to go over all of it. There's quite a bit of information. You just basically throw a rock and you can see any institution, any of the big ones. You've got Visa, you've got MasterCard, you've got Chase, JPMorgan, you've got the IMF, Bank of International Settlements. I'm pretty sure IMF for sure. Like the biggest Lloyd's of London are tokenizing things, like the oldest insurance company in the entire world. Like the guys who made up insurance are tokenizing things. So it's all over the place. And
all right. So that's what I had for you today. Thank you for hanging out with me until the end. And if you like the video, please give me a like, give me a comment, share the video, subscribe to the channel, and we'll see you next time. Bye-bye.